Welcome back to the secret language of charts. In previous episodes, we focused on the major turning points, the reversal patterns that signaled the birth and death of trends. But what happens in between? A healthy trend doesn't move up or down in a perfect straight line. It breathes, it consolidates, it builds up energy before its next big move. Today, we're going to study exactly that. We're diving into the world of continuation patterns. These formations are temporary pauses in the action, but don't be fooled by their apparent calm. Often, they are the prelude to the most explosive and rapid moves. They are the calm before the storm. In this episode, we'll cover 3 of the most common and effective continuation patterns: flags, pennants, and rectangles. Learning to identify them is crucial for knowing when a trend is just taking a breather before continuing its journey, and not reversing. Let's learn how to trade the market's pauses.
Let's start with the 2 fastest and most dynamic continuation patterns, flags and pennants. Both share a fundamental feature that defines them, and it's the first thing we should look for: the flagpole. The flagpole, or pole, is a strong, nearly vertical price move that occurs on very high volume. It's pure impulse. In an uptrend, it's a buying explosion. In a downtrend, a panic sell-off. This impulsive move is proof that the underlying trend is extremely strong. After this climactic move, the market needs to pause. This is where the flag or pennant forms. First, the flag. After the flagpole, the price enters a very brief consolidation phase that takes the shape of a small, rectangular channel sloped against the direction of the flagpole. If the flagpole was bullish, the flag will slope slightly downward. If the flagpole was bearish, it will slope slightly upward. The psychology here is key. The flagpole attracted a lot of attention. Now, some short-term traders who got in on the impulse are taking profits, creating slight counterpressure. However, the most important thing happens with the volume. During the flag's formation, the volume should dry up completely. Low volume here is a golden signal. It tells us there's no real, convincing selling pressure or buying pressure in a bear flag. It's just a pause to catch its breath, an orderly digestion of the prior move.
The pennant is very similar, but instead of a channel, the consolidation takes the shape of a small, symmetrical triangle. The upper and lower trend lines converge. The psychology is identical. An impulsive move, the flagpole, followed by a quick consolidation on declining volume. The difference is merely aesthetic. A flag is a sloped rectangle. The pennant is a small triangle. The entry signal for both patterns is the breakout from the consolidation in the direction of the flagpole. When the price breaks the upper trend line of the flag or pennant in a bullish context and does so with a resurgence in volume, the pause is over. The trend is ready to resume. Look at this example. We have a clear flagpole, a strong upward move on high volume. Then the price forms this small descending channel, a flag. Notice the volume during this phase. It practically disappears. And then the breakout. The price breaks the flag's upper line, and look at the volume. It comes roaring back. The pattern is confirmed. And the price target? The most common way to project a target is to measure the length of the flagpole and project that same distance from the breakout point. Since these patterns often occur midway through a move, this technique gives us a reasonable estimate of where the next leg of the impulse might end.
Now, let's move on to a continuation pattern that tends to last longer and represents a clearer battle between buyers and sellers: the rectangle. Unlike the slope of a flag, a rectangle is a purely sideways consolidation. The price gets trapped between a horizontal support line and a horizontal resistance line, bouncing back and forth like a ball in a box. Psychologically, a rectangle is a temporary but very well-defined stalemate. In an uptrend, buyers are still active at the support level, but sellers are firmly defending the resistance level, taking profits or initiating short positions. In a downtrend, it's the opposite. It's a battle box where the two forces are in a tense equilibrium, building up energy for the final resolution. As with flags and pennants, the volume behavior during the rectangle's formation is important, though it's often less predictable. Ideally, volume should decrease as the pattern develops, showing a decline in overall interest before the breakout. However, you can sometimes see volume spikes on touches of support and resistance. The key, once again, is the breakout. The pattern resolves and the trend resumes when the price decisively breaks out of the box. In an uptrend, we look for a break of the resistance line. In a downtrend, a break of support. And, of course, the ultimate confirmation comes from volume. A breakout on a spike in volume gives us much greater confidence that it's not a trap or fake out.
Let's look at this case. The market is coming off a sharp decline. Then it enters this sideways consolidation phase. We draw our resistance here and our support here, forming a clear battle box. The price bounces between these levels several times. The prior trend was bearish, so we're waiting for a breakout of support. And here it happens. The price breaks the floor of the box with a wide-range candle and, crucially, with an increase in volume. The downtrend resumes. The price target for a rectangle is calculated by measuring the height of the box, the distance between support and resistance, and projecting it from the breakout point in the direction of the prior trend.
Let's recap. Flags and pennants are fast, explosive continuation patterns. They're characterized by a strong flagpole and a short consolidation on declining volume. They're like a small flag on a rocket about to relaunch. The rectangle is a more prolonged pause, a sideways trading range that represents a balanced battle. Its resolution, marked by the breakout, indicates which side has won and that the main trend is ready to continue. Mastering these patterns will allow you to enter established trends with more controlled risk. Instead of chasing the price, you wait patiently for it to take a breather, give you a clear signal, and you hop on the train just as it's about to leave the station. But not all consolidations are as clear as a box or a flag. Sometimes the tension builds in a different way, compressing volatility to an inevitable breaking point. And that's what we'll talk about in our next episode. We'll explore the fascinating world of triangles and wedges. We'll learn how to differentiate between symmetrical, ascending, and descending triangles, and understand the psychology of compression. And as a bonus, we'll unveil one of the most reliable and revered bullish continuation patterns by traders, the cup and handle. You won't want to miss it. Subscribe to Money Talks US and get ready to see how built-up tension turns into profit.